Good morning from Cornell University in Ithaca, upstate New York. On behalf of the Emerging Markets Institute at the Cornell S.C. Johnson College of Business, welcome to the webinar, Rising Commodity Prices. How high will they go? My name is Lourdes Casanova, and I am the Gail and Rob Cañizares Director of the Emerging Markets Institute. It was only 2 years ago, in the middle of the pandemic, that oil prices went into negative. Oil companies had to pay to store their oil. 2 years later, we suddenly, with the terrible war in Ukraine, we realize that Russia and Ukraine were major suppliers of wheat. They supplied 23% of the world production, maize 18%, and 64% of the world sunflower. And also realize that Russia is a major supplier of oil, the third largest in the world, and also the second largest producer of gas, and also metals that are very important for our industries, nickel for batteries, palladium for car exhaust systems. The supply shocks in these commodities have produced shortages and obviously higher prices, and all this with a wide variety of consequences. Even prior to the war, we had inflation. But of course, the inflation has grown in these last months. And in this country, we see 8% inflation in February, for instance, the highest in 40 years. These high commodity prices made us think that inflation is here to stay. And as a consequence, central banks have announced tighter economic policies, tighter monetary policies. The Fed, for the first time since 2018, increased the rate by 25 basic points. The dollar, the refugee currency of choice, is at a very high. And in the annual meetings of the IMF, the forecast for economic growth was revised downwards. Global growth at 3.6%, the Eurozone at 2.8%, and the US at 3.7%. And in fact, this morning we woke up with the news that America's economy declined 1.4% in the first quarter of 2022. In emerging markets, although the forecast is a little bit higher, still there are question marks regarding China, the forecast between 4.4% and 5%. So is this the beginning of a commodity super cycle? We have here today two great experts, Jeffrey Curry, Global Head of Commodities and Global Investment Research at Goldman Sachs, and Robert Kahn, Director of Global Macroeconomics at the Eurasia Group, and they both will help us answer these questions in this, what everybody calls VUCA world, with plenty of volatility, uncertainty, complexity, and ambiguity. So the first question for you, Jeffrey. So is the title of the webinar, How High Will Commodity Prices Go?
Well, we argue, you're just at the beginning of a commodity super cycle, similar to what we saw in the 1970s or the 2000s. And by the way, it's not just, high prices in commodities. The ultimate goal here is to attract capital to the sector, grow the underlying supply base so you don't see GDP numbers like what we saw, that came out this morning. Because the bottom line with 8.5% inflation and that kind of GDP number, it tells you you're hitting the capacity constraints on the ability to grow. And so what I want to do is just briefly talk about the supply constraints and then briefly talk about, the demand growth that exposed this. And so when we talk about the supply constraints, the term we give it is the revenge of the old economy. Just put bluntly, we did not invest in the old economy for the last decade due to poor returns. Capital was instead redirected to the new economy, choking off the investment that would have been otherwise used to grow the supply base. I could point out, even if you wanted to grow shale production in the US, you're out of sand, you're out of pressure pumping capacity, you're out of trucking capacity, you're out of everything at this point. And one of the key reasons we did not adequately invest, and part of that is due to poor returns. Essentially, investors found better returns in Netflix over Exxon, and capital was redirected into Netflix in the FANGs more broadly. I mean, they became a very enormous part of the overall equity market, absorbed a large share of the available capital. Now, when we think about this story, revenge of the old economy, we coined the term in February 2002 during that dot-com boom when it finally popped. But I want to emphasize this revenge of the old economy, it's cyclical. We saw it in the 70s and we saw it in the 2000s. And each time you were preceded by a big equity market for the new economy. It was the Nifty 50 in the 60s, the dot-com boom in the 90s, and then more recently, the FANG boom. But it ultimately achieved the same goal, which was siphon capital out of the space. But the question is, did the investors do the right thing? Absolutely, yes. The returns were far better in the new economy. Now, what's making this cycle that much more vicious than things we've seen in the past is really this idea, of ESG, banking regulations that have all made it far more difficult to get capital to the sector more broadly. Another way to think about it, it's raising the cost of capital, making it far more difficult to attract capital into the space. So this is that idea, the revenge of the old economy. Let's quickly talk about the impact that ESG has had on it. I like to point out ESG is not a substitute for a carbon price or a carbon tax. If we had a carbon price or a carbon tax, we would have put the carbon price into every equity model. Amazon would have paid its share, not forcing Exxon to bear the brunt of it. Instead, Amazon did not pay anything of, even the overall tax bill was relatively low. It didn't pay for the damage it was doing to the environment over that time period. And the other thing to keep in mind is the price of oil and commodities generated from ESG are far higher and less responsive to price than what you would have gotten had you had a carbon tax or a carbon price. In fact, I like to point out it's a tax where the revenue does not go to the consuming country. Instead, it goes to some place like Russia. In fact, we calculate quarter over quarter increases last year in oil prices were alone enough to fund the $62 billion military budget in Russia. So it has serious consequences. And even in places, like North Africa, the shortages in food right now, as Lourdes pointed out, are acute. All of this due to underinvestment and the ability to supply and deliver these different commodities. So anyway, that's that's the broader story here, and I want to emphasize there's been no change in it. Prices got up to $140 a barrel in oil about 4 or 5 weeks ago, and we still do not see substantial flows of investment. If anything, we see outflows. You look at the equities for energy, metals, and mining, all of them, they're trading with free cash flow yields north of 25%. Some are 30%. What is that telling you? That in 1 year, you can buy out that company for 30%. 3 years, you've taken it private. That's ultimately what ESG will do. Will push all this stuff back into the private space. But the bottom line, no investment. Why is there no investment? 3 reasons. 1, returns in the space are abysmal. I think as Lourdes pointed out, 2 years ago, they were nothing short than epic when you had negative oil prices. So no wonder why the capital is leaving. Point number 2, when we look at the the volatility in this market, it discourages anybody wanting to make large scale investments. It's too noisy. They don't like it. Oil was trading 150 vol. What does that mean? It means you need to get 150% returns just to get a 1 standard deviation shift in price. given that kind of return hurdle, no one wants to invest in it. And you're creating a volatility trap that's discouraging the investment and then kicking up the volatility. And then I put number 3 as being ESG. So the ESG is binding, but those other 2 are even that much bigger. It means we're a ways off before we even get the capital to start to solve this problem. I want to emphasize demand destruction is not a long-term solution to this problem. Only investment is a long-term solution. And so let's turn and quickly talk about demand, because a super cycle story not only needs to have structural supply impediments, but it also needs to have, a structural rise in demand. Before I do that, I want to point out a point. Only low-income groups can create commodity bull markets inflation. And to understand why that's the case, let's take corn. Do high-income people consume that much corn than low-income people? No. Is there very many rich guys in the world? No. Low-income people control the world's volume, while the high-income people control the dollars. When we think about commodity markets, they're volumetric markets. Anything in the physical world's volumetric. Anything in the financial world is dollars. So let's take, what do the world's rich control? Dollars. Can they create financial inflation? Yes. Can they create GDP growth? Yes. They just pump money into the economy. Can the world's rich create physical good inflation in commodity bull markets? Numerically impossible. There's not enough of them in the world to do it. Only the world's low-income groups can create it. What was the China supercycle? 400 million low-income rural Chinese. What was the 1970s? 250 million low-income rural people in Europe and the United States that benefited from the war on poverty. So the key point here is only the low-income people can create this. By the way, why were returns so bad following 0809? What was the financial crisis? The subprime crisis. It was too much lending low-income groups. What was the knee-jerk reaction by regulators? Cut the credit to the low-income people, cut austerity in terms of fiscal transfers, and QE, which benefited the high-income groups or the low-income groups. You pull the carpet out from underneath them. Returns collapsed, money disappeared. What happened on March 2020? COVID. COVID was a crisis of inequalities, and it forced governments around the world to focus on the disadvantaged groups. And when it did, it created a huge surge in the volume of demand for all of these goods like food, fuel, capital goods. And what did that do is it exposed the severity of these supply constraints. So we think about the supply story and the demand story, it's really kind of one and the same. It's a big shift in the way policy was treating lower income groups. And we're in a new world today where pre-COVID, it was all about financial stability. Post-COVID, it's all about social need. And every government everywhere in the world is doing this simultaneously. And there are 3 policies that we're focused on. We call it redlining commodity demand, RED. The R stands for redistributional policies. That's like, the American Recovery Act or the furlough program here in the UK. Or, call it common prosperity in China. I think the key point is they're all focused on the same thing, basically helping, the disadvantaged group. Call it the war on income inequality. The E in our redlining, RED, the E stands for environmental policy. That's the green CapEx. We estimate this decade will be $16 trillion. That's one China from the 2000s. Next decade, 2 Chinas. It's enormous. It's going to create a CapEx cycle on par to what we saw in the 70s as well. Call that the war on climate change. The third one, the D, is deglobalization. Right there was in response to the trade war, to build resiliency in your internal supply chains. What was the trucking problem in the US? It's a poster child to what happens when you onshore. But the key point, take Germany in this deglobalization. They already have a shiny brand new Nord Stream 2 pipeline. They want 2 more supply sources, out of the US with LNG terminals as well as Qatar. It's just more cost, more expensive, and it's frictions on the system that reinforces the higher commodity price environment. So we don't see any of these themes going away. These policies are likely to here to stay. Just finally put it in terms of what's happening near term. We would focus on what's going on in Russia and what's going on in China simultaneously. Do not think that this problem has gone away in Russia. You haven't really felt it yet. The real impact's likely to be felt in the month of May and June. What's hiding it is the lockdowns in China. But let's talk about Russia specifically. Right now, you've lost about 500,000 barrels per day of oil demand, or about 0.5% of the world market. We think that number is likely to go up to around 1.5 million barrels per day as we look into May, June, and July. That's significant. A lot of that's going to be products and markets that are already relatively tight. One of the reasons you haven't seen it is the sanctions don't begin to bite until next month. Also, the people transporting this have been slow steaming it, trying to figure out where the destination is likely to be. So the full impact is in front of us. Turning to China. When we think about China, there you've lost 2.5% of world oil demand with the lockdowns in Shanghai. We call that 2.5 million barrels per day. But they're putting a lot of stimulus into infrastructure right now. Think about what China's doing. One foot's on the accelerator, the other one's on the brake. They're about ready to let off the brake. You got the foot on the accelerator, no supply sitting in it coming out of Russia. These markets are teed up for a very explosive second half of this year. Our target on oil is $125 a barrel. Copper's $12,000 a ton. Those are, significantly 20+% higher from current levels. The ones I would be watching, I think, as Lourdes pointed out, the grains markets. Our target, we could potentially see $10, corn to the upside there. So a lot of potential upside as we go into the second half of the year. So, we want to argue this is just the beginning. Demand destruction is not a long-term solution to this problem. Only investment, and hopefully we're going to see that investment in coming years.
Thank you very much, Jeffrey. A lot of data and very interesting, this RED acronym, redistribution, environmental, deglobalization, while actually we realize that we are in a global world. We need gas and oil from different parts of the world, which is very interesting. Resilience, but at the same time, no choice. We need to buy gas, oil, wheat, corn in global markets. So very interesting paradox. So let me just turn to Robert Kahn from the Eurasia Group. So we touched into prices and all the economic consequences, and also for emerging markets. So what are the most immediate consequences of these high commodity prices? And if possible, which countries are going to be the winners? Shall we talk about oil exporters, Brazil, Colombia, copper exporters, Chile and Peru, soya exporters, Brazil, Argentina, after a terrible decade? Maybe it's time for Latin America and other countries in Africa, but maybe this is not as simple as that. So please give us some light on the economic side, on the macro side.
Well, Lourdes, thank you very much for including me here today, and for the Emerging Markets Institute for hosting this event. Great discussion, and I'm pleased to be able to participate in it. I want to answer your question directly, but to get there, I want to take a step back and start with the Russia-Ukraine war, because how you view that proceeding will very much drive our answer to that question today. Jeff touched a bit on it, and I want to go into some more depth there. This war represents a material, continuing shock to commodity prices and to the outlook for economic activity more broadly. Now, that may be obvious to many people on this call, but it's worth a bit of commentary, because as someone who has spent much of my career looking at this intersection of geopolitics and markets, not all geopolitical shocks drive markets in the way this war has. The North Koreans may send a missile up tomorrow, and markets may hardly move. There are conflicts around the world that have relatively modest effects on global markets. Yet some shocks have profound effects, and this is one of them. And it is interesting to think for a moment about why this war is having profound supply and demand disruptions. And important to emphasize both. The supply disruptions, as Jeff had touched on a little bit, is the fact that Eastern Europe is a major supplier of commodities around the world, particularly to developing countries, and particularly to developing countries in the Middle East and Africa. And so particularly grain, vegetable oil, energy, as well as the cost of fertilizer. There are a number of countries, particularly some low and middle income countries like Egypt and Lebanon, Tunisia, Algeria, Sub-Saharan Africa, that depend directly on shipments of those commodities from Russia and Ukraine. And so you have this direct supply disruption that, as Jeff emphasized, hits on those lower income households powerfully. And I'll kind of come back to how that plays out. It's not just the economics, it's the politics that are affected in that regard. The supply effects are also indirect. We are seeing coming out of this disrupted transit patterns, right? Ships piled up at ports, shipments of goods, even those that are not affected by the sanctions, being disrupted. So certainly there are profound supply effects. And then on top of that, there are demand effects that come from lost income, shock to confidence, and just the general uncertainty that is being felt globally associated with this war. And so this is a significant hit, not just to commodity prices, but also to demand. I think it's important to emphasize we can't look at this just in isolation. This is the third year of a pandemic that has already proved very disruptive. It has created an inflationary pressure that central banks have had to respond to, and that has created creating a reduction of risk appetite and increased vulnerabilities across the world, particularly in a lot of highly indebted emerging markets. And as Jeff talked to, we also have some significant disruptions in China coming out of their zero COVID policy. And here I'm going to take a slightly different take on it. In my view, the zero COVID policy of the Chinese government, which worked extremely effectively in the first 2 years of the pandemic, has been a profound strategic mistake this year in the face of a highly contagious variant of the virus. It is certainly destined to failure, and we are seeing that failure play out in severe lockdowns that are having important effects on global markets. I fear that this is going to continue to be a disruptor through the remainder of 2022. Politically, President Xi seems fully committed to this zero COVID policy. It is tied very much to his legacy, and ahead of a party Congress later this year, at which he is likely to be confirmed for a new term. We see no evidence that he is prepared to use Jeff's phrase, take his foot off the brake as regards zero COVID. And so I fear that that is going to be a continuing drag on global demand, including and a continuing disruptor to supply of commodities. The net effect of that supply and demand, I think, has been to push prices up on net, but both factors are there in play. Yes, they're going to be trying to do more stimulative measures to try and offset that. We heard today some more detail on those measures. It's going to be some more monetary policy. It's going to be more fiscal policy. They'll step back from some of their market cleanup moves of the last year that have tried to dampen risk-taking and reliance on foreign capital. Net, though, it's going to be a drag on growth. And so China remains a factor there. So it's the war coming on top of COVID, on top of Chinese disruption, that I think makes it so powerful a catalyst for market volatility. And that is very much what I think we're going to be dealing with. What do I expect? I think that the war is probably going to take about 1% off global growth this year. Now, that is in my central scenario, in which the battle continues to intensify. This offensive that's underway leads to Russia taking territory in the contested regions, but ultimately probably settling into a unstable stalemate, if you will, which will mean that this war is with us for some time, I'm sad to say. That's my central scenario. That's what I'm expecting. We're going to continue to see horrific images. I think that means the West will be compelled by public opinion and by their own ethical views to provide continuing support to the Ukraine government that will contribute to the battle, and also through intensification of sanctions. We have not seen all we are going to get. There will be more, and we will see more of firms leaving on their own accord, breaking trade with Russia of their own accord. I actually believe that even in this central scenario, we are likely to see a near full breakdown of oil and gas trade between Russia and Europe, and between Russia and the other major allies in the alliance against Russia in this war. So that is a significant hit to global demand going forward, will affect commodities, and part of why I think at least 1% loss of GDP over the course of the year, and another 1.5% increase in prices, which is going to be powerfully felt to many of these countries that are already being hit hard by this rise in global commodities. Who gets hit the worst of this? Well, Europe. They had stronger trade relationships with Russia. The oil and gas break will be most significantly felt there in the near term, but also a lot of the emerging markets will feel this very powerfully. The United States will be less powerfully felt. The other point to make here in terms of the general macroeconomic impact is it does very much depend on how central banks respond. Because there's given this mix of supply and demand shocks, some central banks, and we're seeing this very much in the US, will take the view that demand is likely to remain sufficiently strong. Supply shocks that are pushing up inflation, risks spreading to more broadly through the economy. And so you're seeing that the war, if anything, leads them to want to move even more aggressively to address the inflationary surge and try and bring that back down towards their targets. And so if anything, you see tighter monetary policy. In some other parts of the world, it may cause the monetary authorities to step back. And how those central banks respond will be very important down the road, and how those economies deal with this shock and how much inflationary pressure persists. But by and large, I have to say that this war coming on top of those additional shocks leaves us with a base case of persistent inflationary pressures lasting well into 2023. And you can call that temporary, you can call that permanent. It's almost those are poor terms to describe it. I think persistent is a far better word. Now, what are the implications of that? It obviously has a risk because of the feed through to monetary policy to how the economy performs. It can also powerfully affect people's sense of security, economically and politically. And I think that political point is important. I think, for example, in the US, these higher prices, particularly I think on commodities, including energy, what price we all pay at the pump, we know historically affects voting in US elections. And I think will probably be an important factor in the coming midterms elections. Elsewhere, and we've done kind of a study of how these kind of shocks play through to the politics in emerging markets, it can be destabilizing, particularly in governments that are democratic. And so there is a risk here that high inflation, particularly in commodity prices, creates social unrest and can be politically destabilizing. And countries that are already strained by the COVID shock have limited policy capacity to respond because of the legacy of the last several years. I think we're going to see more financial crises in those markets, more debt restructuring is coming down the road, and that will have, as I say, political and economic consequences as a result. What does it mean for let me say for something for about, before I talk about a few specific countries, I've described to you my core scenario for the conflict. The reason I wanted to start with that is, unfortunately, there's tremendous uncertainty about how the war will proceed, which will have an extraordinary human cost, depending on how it goes, but also economic implications. And given the escalatory moves on the battlefield and politically in the last week or so surrounding the conflict, I have to say I am concerned about an escalation of this conflict, which have even more profound implications for global economic growth and inflation. Why? Some of it is simply the war could spread, even including NATO countries at some point. That would obviously be profound. Also, that would be more likely to bring about an even more extensive increase in sanctions, including what economists would call secondary financial sanctions, which would broaden the disruptions associated with this war to a broader set of markets. That is something we can talk a little bit, but the trade and financial disruptions will be wider and more consequential as a result. And what does that mean for some of the most important emerging markets? But as you touched on it at the beginning, China is very much an interesting one. The government is at least said they're committed to 5% growth. The IMF and the World Economic Outlook, and in the meetings last week, said 4.4%. And in the conversations I had with people who came to Washington for those meetings, I think that was kind of the upper bound of what people were thinking of. And so the stimulus that Jeff touched on, which I think is very important, I see as a partial offset to what is significant downward drag. Elsewhere, I think countries like India will do better. The commodity exporting developing countries will do a little better because they may benefit from some of these super cycle considerations as well as some of the disruption considerations. But I have to emphasize that even there, they're not out of the woods, because many of those countries use subsidies on these prices as an important part of their social safety net. So a country like Nigeria, you might say on the surface, the balance of payments will be strong because oil prices are high. And that's true. But at the same time, low oil prices are a critical policy tool of the Nigerian government. And they are not alone. Energy subsidies, food subsidies are really a critical tool throughout the emerging world. To abandon them in the face of very high prices would be, I think, politically destabilizing. I think most countries will try very hard to maintain those subsidies in the face of the shock. But to continue them means a strain on the fiscal budget, which many of these countries will struggle to finance. And so we very much have to keep in mind that it is not just the overall balance of payments, the overall flows in and out of the countries, but what it does to the government's balance sheet and their capacity to meet the core needs of their people that may well be the most determinant to how this plays out in the emerging markets. So where does this leave me? It leaves me with a view that we are at a very fraught time for the global economy, in which we have tremendous uncertainty, geopolitical and economic, and I really am concerned in ways that I have not been for some time about where we go from here. I'll stop there while someone else gets the phone.
Thank you very much, Rob. I just wanted a very short follow-up question. I was surprised by the IMF forecast for Brazil, 0.8% only. And here you are, a country that is exporting oil, I believe is the 5th biggest supplier of oil for China, iron ore, soybeans. So how can it be that the forecast for Brazil, I was thinking Brazil needs a respite, needs to go up, and the commodity prices were going to be. Could you please say a few words about it?
Brazil's in a way reflective of many of these considerations that we are talking about. There are positives, no doubt. You've mentioned some of them. I would also emphasize that financial markets in Brazil have had a very good start of the year, which has created a kind of boost to wealth, although they're giving some of that back right now. But all of that has been supportive of confidence. And indeed, there's a little bit of pre-election fiscal binging going on there, which, but frankly, less than one might have feared, despite what's shaping up as a contest among two people with extraordinarily different views on how to manage the economy. We've actually had a government that's remained up till now pretty restrained in terms of pre-election spending. So all of that has been supportive. But I think fundamentally, we have an economy that has, some deep structural problems, that has limited growth. Keep in mind also that the central bank, reflecting the inflationary concerns that you touched on at the beginning, has raised rates preemptively ahead of countries like the US, very significantly in a way that has had, with some lags, a drag on activity. And so, yes, I think that I've noted that they have not only just 0.8 this year, but only 1.4% next. And I think they also I think the IMF also expects some continuing dislocations from COVID. to be a constraint on growth. So I think you also have to view that as a lag on from the pandemic. I will say, and of course, the IMF can never put this down because politics have to be. Brazil's a member. Is that the huge question mark on Brazil's growth is indeed particularly should Lula win the election, is the direction of policy. And I think markets right now are hopeful that a President Lula would stay reasonably moderate in the implementation of a progressive agenda. But that is, of course, a huge question mark. But no doubt the election is consequential there for future growth.
Let's be optimistic about Brazil, and let's think for a minute that maybe the IMF was too negative and Brazilians need a little bit of optimism in these last years have not been good. So let me now just turn to two students and emerging markets EMI fellows, Ravin Nanda and Mihika Bajate. Actually, both of them are behind this effort with the webinars. It's the end of the academic year, faculty is busy doing evaluations, etc. And they remind us, there are so many things happening in the world. We need to bring this into context and we need to bring this knowledge. So thank you very much, Ravin and Mihika, for insisting that we have to keep these webinars alive to bring, again, these very interesting discussions. So both are undergraduate students at Cornell, at the College of Arts and Science. So thank you very much. Ravin, the floor is yours.
Great, thanks Lourdes, and thank you Dr. Khan and Dr. Curry for joining us today on behalf on EMI. We're so grateful for your time and expertise. Our first question is actually from the audience, from John, and he's wondering, based on Senator Schumer's proposed tax increase to address inflation, what would be the expected effect on inflation if the proposed tax were to be passed?
Well, maybe I'll start with that, and then Jeff, you can jump in. So, first of all, I think the odds that this will pass are low. It's divisive, and ahead of a midterm election that's going to be likely lead to at least some change in power, at least in one of the houses. It's a very difficult time to get any type of legislation through. But to address the question, I obviously, there are arguments that structural problems, and I'll say that broadly, in the U.S. economy are push factors for inflation. That includes tax, and the taxes can address that. Also, antitrust is another strand of the debate. I think tariffs also come up. So I would view this tax question kind of in that bucket of questions. My view is that those kind of taxes, obviously, it can take some pressure off borrowing by the government. Anytime a major borrower of funds borrows less, that takes a little pressure off interest rates. It can provide some modest anti-inflationary pressure. But I think, frankly, its effect on inflations are modest. And in the aggregate, inflation is being driven by these broader supply and demand factors, which have created a significant, in the context of a hot U.S. economy, have created significant supply pressures. And look, that's not all bad. I don't like to say, well, the Fed made a mistake necessarily. A lot of what they did was what we needed them to do at the height of the pandemic to provide us a net under demand. We can argue whether they did too much. The federal government did too much last year or too little, whether the Fed did too much or too little, or should have started earlier. But fundamentally, some of this is a consequence of that relief response. And we are dealing with it. And the right way to deal with it, fundamentally, the most effective way to deal with it is through higher interest rates from the Fed. And I think these other measures are modest in the margin, are not, should be decided really on other considerations than inflation, equity, best ways to finance the deficit, and so on.
Great, thank you so much. And I'm just going to pass this to Mihika for the next question.
Yeah, thank you so much. The next question we have from the audience is, how is population growth influencing inflationary pressure? And this can go to either or both of our speakers.
I'll start with that. Very little. A lot of people want to talk about the 70s as being driven by, the baby boomers. Absolutely not. Again, it goes back to the war on poverty, household formation going up. It matters on the spending power of that lower income group we were talking about before. And so when we think about what's driving the inflationary pressures worldwide, we just saw policy simultaneously on a global basis stimulate all the world's lower income groups, which created huge demand pull on all your basic food, fuel, and capital goods, which is why, it's a commodity super cycle and impacting all of them simultaneously. So it's not the growth of those lower income groups, but rather their newfound access to cash, in that they're now representing that marginal consumer. In fact, in general, I do not, buy those views of reduced, population growth creating deflation or inflation or whatever, because it really, in fact, if you really want to go at its core and you look at it over, several decade period, it's household formation, which is just access to, they call it access to cash for the lower income group. So that's what I'd say is the biggest driver of it.
I absolutely agree with that. I'd say there are two additional points I'd add. One is, if you look, for example, at the US, what can matter is labor force growth. And so, more interesting than the overall population growth will be why people are moving in and out of the labor force, because that can influence inflation. And we saw in the US people dropping out of the labor force for a variety of reasons during the pandemic. I do find intriguing the part embedded in this question, a very long-term and provocative comment, which speaks to globalization. I view COVID, I view this war indeed as well, as in a sense, an accelerant of a trend that was already underway, a pulling back from kind of the hyper version of globalization, the idea that supply chains should be stretched across many countries, assume very easy to move things around. There's going to be more focus now on resilience, on trying to have the capacity to adjust to shocks of the sorts we've seen. And that in some sense means that we all are accessing global labor in a different way than in the past. Indeed, there used to be an argument that one of the factors keeping inflation down was the integration in the global marketplace of labor forces of China and India and other countries that hadn't participated in the global marketplace. Now, of course, Russia is not participating in global markets in the same way. I do think we will have an interesting question in the longer term about how our economy is different in the future than in the past as regards globalization. That might affect the way in which populations drive price formation, but absolutely in the near term, I fully agree with Jeff.
Awesome. Thank you so much, both. Our next question is about oil and gas pipelines. And what do you expect the future of the U.S. gas and oil pipelines to be? Do you expect them to be repurposed or become stranded assets?
You mean, the pipeline network that goes through, basically from Texas up into that Chicago area. By the way, all of those were originally oil pipelines, repurposed to being gas pipelines, back to being oil pipelines. By the way, first time we ever used gas was in World War II, was to move it up there, use it to those oil pipelines. The bottom line, we could end up using them for hydrogen in a decarbonized world. By the way, moving hydrogen is a real pain. But hydrogen could be potentially moved that way. Ammonia is another one. It's really difficult, but it's but I think that's way off in the future in terms of thinking about this. But it's not like, hey, if oil is done, you're going to get rid of these pipelines. There's other sources of energy that can be moved around, and the one I would probably focus on is if hydrogen ends up becoming a real viable carbon-free energy source. The only thing I'd be, cautioned about hydrogen, remember, it was the Hindenburg in, the 1920s that blew up. This stuff's really difficult to move around. But that's what I would say the repurposing that people are focused on is as movement of hydrogen. I don't think you can move it, but we'll see what happens.
Thank you. Our next question is, how can the U.S. ensure the supply chain of electricity will meet increasing demand as we move from fossil fuel to renewable energy sources?
I'm going to take this and just be really, what did I learn from happen with Europe is, the core of that crisis is the wind quit blowing and power generation was down 20%. One thing, I did a little investigation looking into this. One of the complications of climate warming, wind speeds drop and wind patterns change, which actually begs the question, why are we using climate-based energy to fight climate change? Just think about that. This is not I don't think this is going to be an isolated problem in any shape or form, but I think it goes to your question, which is the reliability of electricity production. I come out of this watching all of this. There is only one solution here, given the technologies at our disposal, and that's nuclear. And here's another thing to think about the lunacy of I used to be a big fan of renewables. The more I watch it, I just go, how do we ever get down this path? It's kind of like ESG. Think about the following. As we went from wood to coal to oil, what happened? Energy density went up. Waste is directly proportional to energy density. If you want to become more dense than oil, what's the next step? Nuclear. But where do we go? We're going towards renewables. You're going the other direction. The density is worse than wood. Think about how much damage you're doing to the environment and so on down the list. And also is the amount of carbon used to be able to create the renewables. And I know there's a lot of politics, particularly in Europe, around nuclear, but the micro reactors, they're like building cars. You do them in a factory where you can actually roll them out. And actually, see, that's the point. More people die from turbines, ice coming off the wind turbines, than they do from nuclear accidents going forward. Even Fukushima was not, it's not this devastating. I'm not going to get in the debate about the potential side effects there. But bottom line, more people die from coal, from, lung cancer, things of that nature. What we can learn by watching what happened out of Europe this far is reliability, which is, I think, at the core of your question. Reliability is critical. And if you're actually going to decarbonize and do it at a very rapid pace, scale it up, we're going to have to rely tremendously on nuclear power. And again, the micro technologies, I think, are significant. So, the bottom line is, when people ask me what are the big fuels you need to focus on, I'm going to throw uranium in that and nuclear, because I just think that's going to have to be an important part of this process.
Mahika, can I add just one data point to this question? I find what's going on in Europe now in the context of the war fascinating. Obviously, initially, European policymakers were really scared about the implications of cutting a rapid cutoff of oil and gas from Russia, given their dependence on it. And they're moving very quickly now, mainly as the result of public pressure in this regard. They're now getting an assist from the Russians themselves, who, for political reasons, have started to cut off some gas supply. But if you ask, so I think they're coming around. And as I mentioned, in my base case, I think there's going to be a near virtual ban on Russian oil and gas to Europe before the end of the year, maybe in the next 2 months. But if you look at how they're responding to it, interesting dichotomy between near-term and longer-term solutions. I got asked the other day, is the war ESG neutral, positive, or negative? Well, in the near term, what you're seeing is a scramble by the Europeans to replace that lost oil and gas. And it's kind of an all of the above approach. It's more wood, it's more coal, it's gas from the Middle East to the extent they can get it. That's hard. It's even revisiting nuclear, for which politically things look like that was not going to be possible, but you're seeing the European policymakers readdress that. Interestingly, that's not a great story from a carbon perspective this year. But if you look what it means for policymaking for Europe on a 5-year or a 7-year or a 10-year plan, I actually believe it's going to dramatically accelerate the investment in green technologies. And now that, in the way the Europeans think of it, to Jeff's point, does include nuclear as well, but it also includes that mix of renewables and the like. And actually, it's going to be carbon supportive. It's by accelerating that investment pipeline over 5 years. Of course, the fact that you have a Green Party in the German coalition helps actually now, so politics is reinforcing. That's going to lead to a federal fiscal policy in Europe that on carbon that was unthought about of, literally 6 months ago. And so that idea of a short-term negative, longer-term positive from a green agenda perspective is really an interesting result, accelerated and intensified by the war.
Thank you. I'm going to pass it to Robin for the next question.
Yeah, thank you so much both. And just following up a bit about what you just spoke about, Dr. Khan, how much of a challenge does climate change pose to global inflation going forward?
Well, I want Jeff to should be answering that first, but I'll say something to start on it. There are obviously cost factors associated. You're making a public policy choice. That there are real long-term benefits, public good benefits, including lower prices could be part of that story, from investing in a more sustainable future. But no doubt there are opportunity costs to that, and that is reflected in prices. When people ask me about inflation, I usually think of it in terms of, does that near-term cost reflected in prices kind of spill over to the way people think about prices more generally? Does it affect inflation through the broader economy? I don't think it needs to, but of course that assumes that also that central banks send clear signals of what they're trying to achieve, what kind of prices are likely to resolve. And that's of course hard in the context of all the shocks we're dealing with right now. So there's a lot of uncertainty, but it doesn't have to have a macro effect. But Jeff, you deal with that every day.
I think asking the question of green versus the inflation we're seeing today, you can't distinguish between the difference. Take Europe. Was it the lack of investment in renewables, the lack of the wind blowing? Was it the lack of investment in natural gas? Those are green factors. Was it too much demand driven by the stimulus off of COVID? It's a factor of all of those. But there's just one power price, one gas price in Europe that's creating these inflationary pressures. So trying to distinguish, green inflation from brown inflation or whatever, I think is a meaningless exercise. And I think this is the point that is actually missed is there's a green economy and there's a carbon economy supporting growth. Both are subpar. They cannot support growth. But the two together are the ones that support growth. And they'll always be doing that until we've completed the transition. And the fact of the matter is we only consume things like transportation. I don't care if it's an EV or it's an ICE. You're still getting into it, turning over the ignition and driving somewhere. And the question is, how much is that going to cost you? And that's a function of, the in-use price of, power, oil, all of these things together. So, is this energy transition going to be inflationary? Absolutely, yes. The amount of CapEx it's going to require is going to be unprecedented. And we haven't even scratched the surface. Next year, it's going to be the first big slug of CapEx you see. That's going to stress the system tremendously. We haven't seen a CapEx cycle really since, the early 2000s during the China boom. So we haven't been through one in quite some time, and we're going to start to see it. That's what's going to be inflationary. But I want to emphasize trying to disentangle what's causing this. And then, let's throw in income inequality issues on top of that, the deglobalization issues. They're all very much tied, because what is decarbonization? It's deglobalization. So is it deglobalization or is it decarbonization? Nonetheless, all these forces are inflationary, and trying to disentangle which one is the cause of it, I think will be close to impossible.
Thank you. So I think we have time for just one last audience question. And that is, from a public investment perspective, what do you think is the best way to invest in the ongoing commodity boom?
In my view is just, the one thing I've learned in watching this over the last, call it 6 months to a year, nobody has to buy a financial product. Nope, nobody does. Hence, look at energy equities and everything like that. Somebody, in contrast, has to buy a commodity. They have to buy food. They have to buy fuel. The closer you can get to that captive consumer, the better the returns are going to be. So that would mean buy, one of these indices, like, these commodity indexes. They are like the ICOM, the BCOM, something like that. Probably the one that'd be easiest would be the BCOM, which is the Bloomberg Commodity Index. But I think the key point here is do not buy an energy equity or metals and mining equity thinking you're going to get the same story play out. Because one thing we certainly have witnessed over the last, I'd say even 3 years, no matter how the good fundamentals of a stock are, nobody needs to buy it. And because of that, these things are tremendously undervalued, and there's no reason to think that they ever will become valued. They could end up becoming private. So moral of the story is buy the commodity itself.
And I would just add from a macro perspective, the U.S. economy fundamentally quite strong, but we have just been subjected to an extraordinary range of shocks. And there are important ways in which one thing I can be sure about is that the U.S. economy is going to look different and operate differently coming out of this than it did in the past. The way in which we work, the way in which we communicate, and also the investment dynamics, including the level of inflation. I have no great confidence at the point that we would return to the period of very low inflation and stable prices that we lived through over the last 20 years or so. Now, in saying that, I am reflecting a certain amount of gray hair. I grew up in a period of much higher inflation and unstable inflation, which had profound effects on investment and with lasting consequences. So I think you are very much influenced by when you came of age as an investor or as an observer. But very much that has created a sense of mind that we do very much have to have an idea of what the post-COVID world will look like in framing our views.
Thank you so much for your answers to these questions, and thank you to the audience for submitting all of these amazing questions. I am now going to pass it back to Professor Lourdes Casanova to wrap up.
I would like to finish with a personal anecdote because you, Jeffrey, talked so much about nuclear and how difficult these decisions are. So I was a young student in Holland when Chernobyl happened. And that Monday, there was a referendum regarding nuclear power. And then Chernobyl happened. If Chernobyl would have been in Holland, Holland would have disappeared as a country. So then the referendum was canceled. And of course, the decision of Holland had repercussions in Germany. And Germany, of course, and Holland turned to gas from Russia as a source of energy. So these decisions are extremely difficult. We probably will need a pool, as you were saying, Jeffrey, of different sources of energy. And definitely all these things have tremendous consequences. Let's hope that from some emerging markets, the oil exporters, the commodity exporters will be good news. And at least these countries will be able to help those that are more difficult. There are news also whether India should start exporting also agricultural products in other countries as well. So let's hope that solutions can be found and we see a more rosy picture in the next year or so regarding the situation with inflation and high commodity prices. So to be continued, this is a first discussion. And of course, depending on the circumstances, on the war and many other factors, things will go one way or the other. So thank you very much, Jeffrey Carey from Goldman Sachs. Thank you very much, Robert Kahn from Eurasia Group. And thank you, Ravin Nanda, Mihika Bajate, great students from Cornell. And thank you to the eCornell team, who is always a pleasure working in partnership with you to organize these very interesting discussions. So thank you all, to be continued in our next webinar. Thank you.
Thank you. Bye-bye.
Thank you, bye.